I'm Sebastian Mullins, Head of Multi-Asset for Schroders Australia. The market continued to rally this quarter, with equities up over 7% in local currency terms. US equities delivered around 10% over the quarter as people started to price out the view of recession and seeing more positive growth and more positive consumer spending. However, Japan was the standout, delivering around 22% in local currency terms this quarter. In terms of bonds, bond yields backed up over the quarter, as in the US, for example, market participants went from pricing in 150 basis points worth of cuts to around 80 basis points worth of cuts at the end of this quarter, which is around the 75 basis point guidance given by the US Fed. That made bond yields move up over the quarter, with the US 10-year Treasury yields ending at 4.2% and move higher around 30 basis points over the quarter, or in price terms, a loss of around 2%. Credit spreads tightened over the quarter, however not enough to offset the loss from the sovereign bond components, with US investment grade credit falling over the quarter, European investment grade credit around flat for the period, and Australian investment grade doing quite well, around 1.5% returns in local currency terms over the quarter. High yield did better, delivering around 1.5% in US high yield, but emerging market corporate high yield did the best at around 3.6% return in US dollar terms over the quarter. Currencies mainly moved because of the US dollar, with the Dixie moving around 3% over the quarter, but the main move was the fall in the Japanese yen, despite abandoning yield curve control and increasing rates for the first time in around 17 years, saw the yen fall around 7% against the US dollar. And finally, in commodities, oil rallied around 14% from the low at the beginning of the year to the end of the March quarter. The Schroder Real Return Fund wholesale class delivered around 3.7% net of fees over the March quarter, bringing the 1 year return net of fees to 8.7%. Pretty much all asset classes added over the quarter, except for duration, which detracted on the margin. Equities were the main positive contributor, along with insurance-linked securities, Australian high-yielding debt, and securitized credit. Currencies were around flat over the period, but our allocations to commodities and commodity equities also added on the margin. Markets spent most of last year discussing whether or not we'll have a hard landing. As we've come into 2024, the narratives move from whether we're going from a hard landing or to a soft landing. The question we have is, should we be talking about a no landing at all? Because economic growth continues to surprise to the upside, especially in the US. If you look at this slide, you can see that economic growth was starting to fall in the US towards the end of last year, but it's since started to recover pretty aggressively since then, without inflation really picking up dramatically. One of the expectations last year was at the end of having rolling recessions, since COVID-19, we saw manufacturing fall into recession as services did really well after the reopening. The idea was, after very high rate hikes, especially in the US, that spending on services would start to roll over and services will join manufacturing in recession, the hard landing. However, as you can see on this next slide, on the right-hand side, the belief that manufacturing ISMs are going to start increasing in the coming months. What we look at is new orders minus inventories to give us a lead on where that metric may end up. And as you can see, it's moving above 50. So rather than services catching down to manufacturing, we're seeing manufacturing catching up to services. And if we look at the flash PMI from S&P, the current manufacturing service flash PMI is 52.5, or the highest it's been in 21 months. So we're starting to see a broad-based recovery. So rather than a no landing or a soft landing, maybe both of these sections are actually accelerating together, having a synchronized upturn, which could lead to the no landing scenario. This has caused our economic team, who on the left-hand side show our view of what we think US growth will be this year. Originally, the view was that GDP growth in the US would be 1.3% this year, but our economics team now suggests a 2.7% GDP growth this year, a far bigger upgrade than expected. And that's how we shifted our view from being a soft landing to most likely a no landing in the US. However, while that'd be good for economic growth and potentially equities and risk assets, it does put pause on the expectation of aggressive rate cuts from US central banks. Here on the left-hand side, you can see that the market is now pricing in 75 basis point cuts this year, which is in line with our expectation and also the Fed's expectation through their guidance. That might also be a little too much. We're starting to think the market might move to price only 50 basis point cuts this year, which would be a buying opportunity. However, if you look further out on the right-hand side of our graph, expectation for cuts in 2025 still look pretty optimistic. We do not believe they'll cut as much as the market expects over the next 2 years. and for those reasons we're more dubious on buying duration, but would like to trade the range as those expectations shift throughout the periods. We still remain pretty positive on equities. Now, equities have moved pretty far, and people are discussing how expensive markets like the US have become. The US hits all-time highs, and even Japanese equities have hit the all-time highs. But earning growth assumptions are still quite strong for these markets, and our top-down macroeconomic models agree with these earnings expectations looking forward. So we do not believe that these expectations further out are too stretched. And if you look at this graph here, you can see that upwards revisions, that is analysts improving their view on earnings looking forward, continue to be strong for the US and Japan. That's why we prefer US and Japanese equities within our equity allocation. We are overweight US equities because of the strong earnings growth and the strong US economic backdrop, and we like Japan because of its relative cheap valuations, at least compared to the US, and structural tailwinds from structural reforms in corporate governance, and also potentially a boost from technological advances in robotics and AI. Throughout the quarter, our equity allocation increased. We added around 7% to equities, reaching a peak of around 37% in equities over the quarter. We pulled that back at the very end of March to bring our total allocation now to 33% delta adjusted. Having participated in a very strong rally, having added to US equities and Japanese equities at the end of last year. At 33%, we still think this allows us to capture upside, but we are sort of protecting and hedging some of our downside risk given stretch valuations, stress positioning, and sentiment. To fund the allocation to equities, we did trim our allocation to credit over the quarter, removing around 4% from US investment grade credits and 4% from US high yield credits, because we believe their spreads are very narrow, providing you great carry, but not much further room for capital appreciation. We don't expect spreads to widen, but stay steady, but prefer to take upside optionality in our equity allocation. We added 2% to commodities, that's physical commodities through futures, and also 1% to energy equities via futures. This gives us an exposure to an asset class that is not yet repriced for the soft landing or no landing scenario, and helps protect the portfolio if there is another bout of inflation. The portfolio also added around 2% to emerging market debt and around 3% to securitized credit, where we believe there's better value in US securitized credit than US corporate bonds. We also changed our duration on the margin. We started the year with around 2 years duration and ended the quarter with around 2.25 years duration, an additional quarter of a year of duration in the portfolio. However, under the surface, we were quite active. At the beginning of the year, we sold volatility on US Treasuries, given the high uncertainty around Powell and the FOMC meeting. When that meeting occurred, volatility collapsed, providing us to capture that premium and add income to the fund. We then bought put options on Treasury yields. As yields rose, we participated and protected the portfolio, and then we sold those at a profit and then added to duration. Within equities, we continue to hold puts in the portfolio to protect for the downside risk. We are still quite positive on US equities and Japanese equities, however they have moved quite far and positioning and sentiment is stretched. By having put options in the portfolio, any moderate drawdown we protected and allow us to buy the dip.